Hello and welcome to Income Ave recording, navigating the bond market. I'm J.R. Gondeck, as always, joined by portfolio manager Matt Taylor. Matt, lots happened over the last quarter in the stock market, bond market, maybe a little less to some degree, but let's kind of recap, give some thoughts of what's ahead and look to the second half of the year.
Yeah. So let's start off first with the Fed meeting back in June, June 9th to June 18th. So the one thing they did do is update their dot plot. And one noticeable thing on the dot plot is the shift upwards. So back in March of 2025, you see you had numerous people with 1 and 2 cuts. And in the June dot plot, a lot more people came in and said we're only going to have no cuts this year. So it was 4, now it's 7. They only have 2 people in the 1 cut camp versus the 4. And then you still have the majority of the committee saying 2 cuts this year. So while the 2 cut scenario is still the base case, more people have shifted higher. Then you also saw that in 2026, that rate path also moves a little bit higher. So that's showing a little less dovish Fed currently right now as of the June 2025
Well, and
projection.
Matt, I look at this, from the challenge, right, of trying to figure out what the tariff impact and all this stuff is, right? And to me, it's the Fed's in a tough spot. All the Fed governors trying to see where things are going, and they, in the short run, have definitely been more conservative as you've seen expectations move up a little bit. So again, as we've been talking about this, data dependent as to what happens. Obviously, a big week in the labor market to see, is the labor market weakening? If that's the case, maybe the Fed will update some of these. But as we sit here today, this is where it's at.
Yeah. And then if you look at other parts of the meeting, they put out their additional information on the summary of economic projections. And they did downgrade the real GDP growth to a 1.4 from a 1.7, so it's a 3/10 drop. They increased unemployment expectations about 10 basis points this year and in the out years. And then for PCE inflation, they increased that 3/10 this year, and then also pretty significantly in the out years, 26 and 27. And this has to do with some of the tariff expectations and things like that. So the Fed's kind of in an area where they are slowing down growth expectations and increasing the inflation expectations. So the one thing I'm looking at is going to be that unemployment rate, because that's really the thing that could move the Fed to make, if we see that pick up to significantly higher than a 4.5, the Fed could be quick to cut rates in that scenario, in my opinion. If it stays below there, they think they can be patient probably.
And Matt, we've had this debate over the last few months, and to me, the wild card as we look at the second half of the year is: are we at peak growth, and is inflation going to pick up? Or will inflation kind of stay where it's been? And consumer confidence, to me, is the big wild card. We've seen a pretty good recovery in consumer confidence, and will that lead to future growth or not? And again, I think that's what the Fed is not anticipating, that confidence will continue. So maybe that's part of the reason they've downgraded a little bit. They want to wait and see that will lead to future growth, where historically that confidence is a pretty good forecaster of what's ahead to the positive when it's where we
Yeah,
are.
yeah. And ever since the Fed meeting, we have had a lot of different Fed members come out and give speeches and make projections. And the view is definitely very diverse out there. Depending on who you're listening to, they see the economy progressing differently to that effect, like you said, JR. So while you have Jerome Powell emphasizing patience and waiting for clearer indications before doing anything with Fed funds, you also have someone like a John Williams, who's a little more dovish typically. He's saying that tariff impacts still mounting. He doesn't mind being a little bit restrictive. And you have other people like Barkin saying no cuts. And he's more in the wait and see approach. And then, you get to the more dovish governors like a Neil Kashkari and Austin Goolsbee, who's saying that the tariff impact has been less than expected. Then the two appointees from the Trump first administration, Michelle Bowman and Chris Waller, are both out saying they could support a July rate cut if inflation remains in check. While Waller is even saying, going as far as that the tariffs are just a one-off level effect, and he wants to cut rates in July probably, which is interesting. Now, there's a lot of stuff in the news lately about the next Fed chair. It seems that Jerome Powell will more than likely be out at the end of his term come May 2026. And there's three individuals leading the way right now and this is according to I think the poli sci betting market. So Chris Waller is currently in the lead at 22%, followed by Kevin Warsh and Kevin Hassett. You'll see that Michelle Bowman, after her comments about cutting rates in July, she went from a 0% chance to roughly 15. So you saw her probability jump up, but it seems like the three front runners are Waller, Warsh, and Hassett. Chris Waller is currently on the Fed. Kevin Warsh was on the Fed of Governors. He's typically a little more hawkish, so it's a little surprising to see him as high there. But he is definitely, has Trump's ear. He's been, spotted over there and talking to them. And then Kevin Hassett's the current head of the director of economic policy. So it's with these guys here, it's really interesting to see, what they say going forward. Because you could have that situation where you have this shadow Fed governor, and their words can mean a lot more to the markets than Powell's as, we get closer to the end of his term.
Well, and as Matt, as we said, the Fed chair is one vote, right? On the other hand, the markets are always grappling for signs of, what the Fed might do. So I agree. I think you can see these people speaking, especially if they're talking more favorable to cutting rates, to see the market move. We'll see if it actually happens, obviously, because we're, 11 months out from that person actually taking, the role, right?
Yeah, and a lot of things can happen in 11 months. We've seen that many times. So going forward, there's a couple of topics that, has come in the news as of late. One is the supplementary leverage ratio, or the SLR. Now, just super high level, just kind of go over what this is. This was um, a ratio that was put into place after the great financial crisis that is requiring banks to keep a certain amount of tier one capital on their books to absorb any kind of shock to the economy. Tier one capital is basically going to be common equity and reserves. For the largest U.S. banks, the SLR was at 5%. The Federal Reserve recently came out and introduced a proposal that would lower that requirement to between 3.5% and 4.5%. This is a long process. It goes through a 60-day window for public comment, then it goes through review of rules and things like that. And then after all that happens, it would finally be approved. So you probably have a couple months out to any of this takes effect. Now, the whole purpose of lowering the SLR in the regulators' minds is to allow these banks to own more treasury debt, especially during times of market volatility. Back during COVID, you saw issues where these banks couldn't buy more treasuries because they would trigger the SLR, even though treasuries are considered a risk-free asset, it is not included in the tier one capital. So this is giving them a little extra buffer to come into the treasury market during times of volatility and buy those treasuries if needed. Obviously, when you lower the SLR, it'd be interesting to see how these banks actually act. Do they actually maybe increase some of their loans out there instead of keeping that extra dry powder for treasuries? Who knows? Currently, most bank institutions have their SLRs in the 5.7, 5.8 range. I think there's a couple in the sixes. So it's pretty close to that 5 level. But once again, time will tell on how these banks act. And the other big financial news coming out that could really affect the bond market is the tax bill currently being voted on in the Senate today, in the vote-a-rama. This is a comparison between the House bill and the Senate bill from a week or two ago, so it's not 100% accurate. But the bottom line is, and what we're focused on, is that debt ceiling increase. So the Senate bill currently is expecting to ask for a $5 trillion increase to the debt ceiling. And if you're looking at the CBO, the Congressional Budget Office's markup and estimates of what this will do to the deficit, they're now estimating between a 3.5 trillion and a 4.2 trillion dollar increase to the U.S. deficit. You take that would all have to be funded by issuing more debt. So supply would increase significantly in this scenario. Now, once again, this is assuming there's not growth. There's no the growth is constant. And there's not we don't see any other pickups in income. So we'll see. But with that large of an issues in bonds, it's a little concerning to see who would take all that when you see that big of an increase in supply.
Well, Matt, we've talked about this, kind of the short-term impact versus what ultimately is coming, right? And short-term, as we've seen, intermediate and long-term rates have come down a little bit. Maybe they have a little more room to go, but looking at these big numbers, a year, two, three, four out, assuming that, we don't have above average economic growth, there could be concern with this, right? And this, you think about all the extra supply overall, that could drive rates a little bit higher over time, right? I mean, even if inflation comes down, and that definitely is something market's not focused on, but I think as we're thinking about this a year or so out, that it could be a challenge.
Yeah, because currently looking at where the treasury outstanding right now, I think there's about $36.2 trillion in treasuries outstanding currently. Of that, just under 29 trillion is owned by individuals, while the rest is owned by government agencies called the Fed. Um, and then so that'd be an increase of, just in the deficit side, over 10-15% roughly, depending on where it shakes out at of supply. So that's significant. And then one thing we did want to touch on briefly today was also the mortgage market. And we've definitely seen cooling of mortgages lately. While US Treasuries are even at 4.5 they've been going between 4.5 to 4.1% for the past couple months. So the treasuries are not necessarily, causing the mortgage market to come lower. It's the stability within the treasury market. So with this slide here, we're showing the mortgage rates over the 10-year treasury, and this is from beginning of 2024 to now. And if you see here, you saw a huge spike. So the risk premium lenders would require a borrower to pay for a mortgage over a 10-year treasury was at 185 basis points back in August of last year. And this has slowly but surely been coming down. We're currently sitting at a 1.6. So that's about 25 basis points of easing just because less volatility within the treasury market. And
Well,
what
and
I
I think we've seen this, right, Matt, in mortgage buying activity, slowly, right? And again, I think it's something to watch the second half of the year, because again, when the markets are super volatile, everybody freezes on big ticket purchases. But now that, like you said, you're 1.6% spread now, and it's come down a little bit. People see they don't see the 8% mortgage anymore. Now you're in the sixes, and you could continue to see more activity in the second half of the year based on that stability.
definitely, definitely. And looking, even out a couple years back more. So you'll see back from, 2021 to 25, we were as high as a 2.6% spread at some points, especially in market, volatility. So you've really seen these spreads for mortgages over treasuries significantly get reduced. One other thing I like to look at is where were we before the pandemic or COVID? Um, so looking at a time period between 2015 and 2020, that's a nice little U chart there, but you'll see we bottom out right around a 1.45% spread. So the one thing I'm looking at to see, continued declines in the mortgage rate, you probably only have about 10 to 15 basis points of additional tightening. You would need the treasury market to really participate and come down more to see mortgage rates get, below a 6 and in the fives again, probably.
So Matt, as we think about where to invest the rest of the year, I mean, for the most part, bond market's been pretty steady, stable, despite all the volatility first half of the year, right? And, depending where you're invested, 3% give or take. I mean, bond returns have been somewhat similar to stock market up until the recent few weeks of rally overall. So as we sit to the rest of the year, what are your thoughts on putting money to work? Where's the opportunity? What maybe to avoid, looking at the last half of the year.
Yeah, for the rest of the year, we're still approaching this bond market with caution. There's a lot of things going on and a lot of different cross currents. Like this might, mean that yields should go lower. This might mean that yields should go higher. So it's trying to, pan through all this. We still looking at being cautious, not taking on a ton of duration risk. We do think there's a a lot of value still in this intermediate barbell strategy where we will be looking at, short term, call it, 6 months to 2 year paper, and also looking more in the belly between 5 and 7 years roughly, and then sprinkling, portions, where we see relative value within the bond market. Now, by doing this, this is going to provide us good flexibility and it's going to allow us to evaluate these policy changes as they come to us. So with money coming due on the shorter end, we can then redeploy that where we see the best opportunity. And with everything else being equal, you're not getting too much of a difference in yield between, call it the 7 year and the 2 year space versus something in the 10 and longer space. You're not giving up a lot of yield to do that, but you're protecting yourself from duration. So
Well, on top of the treasury supply concern looking a year out, right? So it gives a flexibility if, rates do move up dramatically, a year or two out, total flexibility, protect that principal. And to your point, you're not missing out much by staying shorter for now.
exactly. Yep.
All right, but that way, thank you for listening and we'll catch up next quarter.
Good one.